Antonio, good morning. The things that have the street concerned seem to be mostly about supply, it seems to me, versus demand. I mean, there are some issues around China lockdowns and Russia as well. But is that the way you would frame it?
Yeah, I mean, we had another good quarter. Our demand continued to be amazingly strong and persistent. You know, we reported for the fourth consecutive quarter 20% year-over-year growth in our demand for our product and services, and in particular with strength around the HPE GreenLake, our edge-to-cloud platform that you can consume as a service, which doubled again for the third consecutive quarter. So we see very strong demand for product and services. That has not changed. What continues to be the challenge across the industry is supply availability. And this quarter, we announced we are exiting Russia and Belarus. So we felt that was absolutely prudent to revise our guidance, which is not different, John, than the guidance we provided at the security analyst meeting in October. In many ways, I actually consider remarkable that we maintained the original guidance we provided last October for the full year, including the revenue growth of 3 to 4%, the EPS of $1.96 to $2.10, and the free cash flow from $1.8 to $2 billion. So we are very pleased with the momentum sales, but obviously we have to navigate the supply chain challenges that we all continue to experience.
Yeah, this is one of those markets, though, where you can say the same thing that you said before, but it just hits different, right? Because the context of other things has been different. So let's talk about that July guide. You expect revenue to be up in the low single digits sequentially. I believe that's a little bit below normal seasonality. How much of that is the China COVID lockdowns? How much of it is perhaps overall squeamishness with customer demand in any particular geography?
Now, let me start with the demand. We have more demand than we need to achieve the full year. I can tell you that our backlog has not yet peaked. It is high quality, meaning it's firm, meaning the order book is firm, and it has been priced to preserve the gross margins that we reported, which actually were very, very strong. So from that perspective, no worry at all. I think for us is to get that continued line of sight with component availability and obviously the China lockdown, which in our Q2 results was reflected in the commentary we made yesterday, which was close to $250 million and 6 pennies. So the lockdown, we expect that to easy up here as we move into the June month. And then as we have better line of sight, of course, we'll continue to work aggressively to translate that amazing backlog and continue persistent demand into revenue and profitable growth.
Okay, now into the company itself, operationally, what's your posture on costs? How aggressive are you being there? What are you doing with hiring, with raises, which have been an issue for a number of tech names?
Yeah. Well, as you recall, when the pandemic hit, we were actually the first company to take deliberate actions to position ourselves into the future by reallocating resources into the areas of growth that now are paying off, whether it's HPE GreenLake, again, which now we have more than $6 billion in the balance sheet that has to unwind over the next 8 quarters with an impressive momentum, or whether it's the Edge, which again recorded a 45% growth for 4 consecutive quarters in orders. And so we feel we have this well under control, but obviously we're going to be judicious about hiring and what I call expenses to make sure that we don't get too far ahead as we continue to assess what the demand is as we enter 2023. But we believe, John, we are very well positioned with the actions we took in the last, call it 6 quarters.